we've got Feroze Azeez, the joint CEO of Anand Rathi, joining us this morning. Good morning, Feroze. Welcome back to News9. Pleasure having you here with us again. And of course, we were reading the market outlook report that Anand Rathi has published. And I think one of the main concerns right now seems to be around the H-1B visa overhaul. And your report says that it's likely to hurt the mid-cap IT firms more than the large-cap ones. And the effects are likely to be seen from FY27. Why do you think it's going to be the mid-caps which are going to hurt more?
Kartik, like you rightly said, the H-1B visa is going to hit the mid-cap IT more, because what's happening in the mid-cap IT is they were already reeling under pressure of a large headwind in the IT sector. And the mid-cap space, if you look at the kind of dependency on outsourcing services, is a tad more than the large cap space. The third is because the valuations in the mid-cap IT have got a little stretch from a valuation standpoint. All these three as factors are a headwind to the IT space, especially the mid-cap. When it comes to sectoral allocations, we have been negative IT over the last 7-8 months. And I think this is reasonably extra blow, or can't call it the last nail in the coffin, but that's too pessimistic. But I think at least interim, you will see more pain in the space.
Okay, more pain in the space. So what should investors do right now, Feroze? What do you suggest those who are holding on to some of these mid-cap as well as some of the large-cap IT stocks? What should those investors do with their holdings?
See, I think if there is something which is not a short-term kind of a problem and a long-term kind of a structural difference in the P&Ls of companies, I would definitely say there's no reward for bravery in the capital markets. Bravery is not something which you should exhibit.
Okay.
I personally would like a client or an investor to move to sectors which have been bullish on A, B, C, D, E. Is an abbreviation for people to remember: automobile, banking, consumption, drugs, and drugs as in pharma, and E as in renewable energy.
Okay.
These are the 5 sectors which can have a potential to beat Nifty over 3-4% annually for the next 2-3 years. And this is where, if your portfolio is a little more skewed, your excess returns over Nifty become higher and higher probability.
Oh, fantastic. So A, B, C, D, E, an easy acronym for investors to remember. Thanks for that, Feroze. I also want to touch upon another point that you highlighted in the market outlook, and this happens to be about the market performance. And the report suggests that drawdowns are in line with historical average. But I think investors would be wondering that it's almost going to be just in a few days, 1 year to markets touching the peak record high, and the entire last year has been flat, albeit a little negative for some investors. But you're saying that the drawdowns are in line with historical average. What else does history tell us? How soon can we see some recovery?
See, market is a very, actually, people think that market is not predictable. Market is very predictable in the long run. You just see the last 1 year, like you rightly said, Kartik, Nifty has done nothing, 26,200. Down to 25,200, almost a year, another 2 days. I think if today is 23rd, 24th of September, tomorrow, I think you will finish exactly 1 year of correction from the peak Nifty has ever achieved. But if you just encompass another 1 year before that, October 23, I remember very clearly the expiry of October 23 was 18,700.
Okay.
So if you look at 23 months from 18,700, it's come to 25,200. You have to just see whether you will see the glass half full or half empty, or full, because
Right.
there's half the glass is air and half the glass is water. You can't ever have half the glass empty.
Right.
So point is, if you look at 23 months, Nifty has delivered 6,000 points on a base of 18,000, which is like a 13-14% per annum return, even after a 1 year time correction.
Right.
Market always gives you return in pockets and then relaxes in a park, like a central park, and says, okay, wait, let the rest of them jump in and then I'll move again. So as long as you understand this small little behavioral pattern of the market, you'll be able to take the benefit. Unlike real estate, people don't make money in equity because they're not acknowledging this static behavior of any asset class, real estate also, the house I'm sitting in, if this building was built 15 years back, it has moved up 12 times from in the last 15 years, but there were 5-year pockets where it gave no return.
Right.
But I hung on to this property. So a little more philosophical, but I personally think market has delivered 14% for 2-year pockets. 1-year correction itself implies time to get in.
All right, time to get in is the view coming in. I also want to touch upon the economic tailwinds which you mentioned in the report, and of course no denying the GDP growth that we saw for Q1, and of course that has far exceeded the expectations, also revising the annual growth forecast to about 6.5%, and inflation also continues to be below the RBI's target. Overall, the fiscal deficit also should be improving now with the GST cut that we've seen, likely to prop up some demand. So economic tailwinds, obviously the fundamentals of India's economy is strong, but the things which are not in our control is what is happening outside of India and globally. Those are things which could continue to act as tailwinds. So how do, I beg your pardon, as headwinds. So how do domestic tailwinds and global headwinds sort of clash for investors to get a view on which direction the markets are going to take?
See, I think, Kartik, like you rightly said, domestic economic variables, if I have to rate them, they are 9 on 10. And that's the macroeconomic variable you need for a good, conducive, fertile ground for market to perform. Second, global headwinds, I would say they are 2 on 10 in terms of supporting us. But the good part is the headwind from the global side has been bad for the last 7-8 months. Clearly, after Trump broke out the tariff war. So I think a lot of monies have already gone out from the FII fraternity. See, if somebody sitting in the US is hearing Trump that India is going to have a 50% tariff, he will surely sell or she will surely sell. But they've already sold. That's why Trump also was not successful in creating a panic in the equity market. But bechega kaun? A domestic guy, if I speak to a fund manager, he says, bechunga to karunga kya? Right, I am already getting 28,000 crores of SIP money. If I sell a stock, what do I do with it? So point is, you need a seller for every panic. So panic created no seller, no market follow. So markets have not gone down to 21,700 from March, where it was lows, which it created. So coming back, if you look at the global headwind, I'm not too worried about the global headwind because that has already languished for 8 months and has created a lot of outflow. But Indian money is going to continue next 8 years. Statistically, if you extrapolate, 52 lakhs is what domestic institutions will put into equity markets. Like the last 4 years has been 15 lakhs. Next 8 years is going to be 52 lakhs. So if that's going to happen, market is going to remain buoyant at least for a few years, and pessimism of crashes would be difficult to fructify.
All right. So again, so what you are potentially alluding to is that the DIIs are absorbing whatever the FIIs are doing in terms of negative action. But there's also an interesting point which your report talks about, which is the boost to long duration bond funds. So for those investors who are perhaps not getting the kind of returns that they are looking at from equity markets, do you think this is the time to perhaps dabble a little bit into bond markets as well?
Kartik, see, I think if you are a big treasury, that part of the report is relevant to you if you're writing. Because what happens is tax inefficiency will eat away the capital gain even if there is any 10-year G-Sec softening. So if you've already seen see what has happened is the spread is very low. The 1-year, 10-year G-Sec and the repo rates are just about 1% away. Historically, the short end of the yield curve has been lower than the long end of the yield curve. But I think to answer your question, yes, can you make some capital appreciation in bonds? If not on the 10-year G-Secs because of the spread compression, yes. But tax disadvantage takes away most of this capital appreciation. So I would say for a retail investor or an individual investor, playing the bond market is not worth the buck. I would rather have a hold to maturity play of a 10-year and in a fund which actually combines arbitrage and debt fund to escape the new section of income tax, which is Section 50AA, which brings in short-term capital gain. So if you combine this hybrid instrument of arbitrage and debt, you get a taxation which is very attractive after 2 years, 12.5%. So I think If you're trading in GSEC and bond market, definitely you have some capital appreciation to make. But if you're a person who's wanting to hold it long term, then I think tax inefficiency will eat away all the capital gain which the bond market has to offer, if at all.
All right. And finally, of course, earnings for FY26. Your report says that earnings are expected to be in the range of about 6% to 16%, a wide enough range, understandably so. But it also seems that perhaps you're saying that the Nifty trades are close to the fair value, but there could be some froth in the small and mid-cap space. Now, this froth emerging from which sectors particularly, and hence, just to rephrase that question, which are the sectors that one should potentially stay away from? You've mentioned the A, B, C, D, E as priority sectors, but with this froth, which are the sectors that one should avoid in this particular financial year?
I would say cyclical metal stocks, defense stocks still have a lot of frothy valuations because there have been very short-term trades taken. Once the momentum goes away, people exit. Any stock in the Nifty Momentum Index, you have to be wary about. You will have to exit at the right time before the momentum play is over. That's one. Second, when it comes to earning, the way the street looks at earnings sometimes has an incorrect behavior. If you asked anybody, NSE Small Cap 250's earnings growth last financial year, that is FY25, most people will tell you it was negative earnings growth or degrowth of earnings of -9%, but that's not the case. Factually, there were 63 changes in that 250 index. If you eliminate those 63 changes and look at the same 250 stocks which currently form the part of NSE Small Cap 250, the earnings grew by 18%. I was speaking to somebody on a panel and he says their small cap key earnings are -9%, but it was not -9, it's +18. There were 63 companies which changed in the index. So you will have to replace back those and then check the earnings of an index, which is not a constant constituent. So I personally think that's why the range 6 to 16 starts from Nifty to the NSE Small Cap 250.
All right.
Three indices are the most important in India. Nifty 100, Nifty 150 and Nifty Small Cap 250 because that's what the institutions are mandated to follow.
Right. All right, Feroze. And as we speak, of course, markets have slipped into the red. It seems like a bit of a choppy day and this choppiness continues. In fact, even on the tech stocks, the companies that were registering slight gains as value buying have now slipped into the red. Feroze, final question to you. Volatility, is that the nature of the game? Should you not get impacted by volatility? Because we are likely to see these ups and downs with the barrage of news, both domestic as well as globally. Is the best strategy still to just stay invested, look at the long term, don't worry about the minor volatility that you see every day?
Kartik, I think life is all about expectation and reality. As a derivative trader, I am cribbing that there is very little volatility.
Okay.
If you are expecting there is zero volatility, markets will open, stocks will only remain 0.1% up or down. Volatility actually in India is very lower, significantly lower on an Excel sheet. Volatility is measured as how much movement per day. If you look at S&P 500's volatility, it is 19%.
Okay.
India's volatility is 16% over the last 1 year, measured in the form of standard deviation of Nifty prices for last 1 year.
Right.
In math, there is no gray shade. S&P 500 has thrown up more volatility than Nifty 50 for the last 1 year, and a derivative trader or an observer will find this volatility lower. So every day, a 0.9% movement in Nifty is an expected volatility.
Okay.
Because there are a lot of derivatives regulations which have started coming from July and August, the volatility has dropped. If you just observe, for the last 20 days, the market has been in the range of 24,400 to 25,200. Every day, Nifty is moving 30, 40, 50 points, 70 points. These are not volatility numbers. Volatility is a gap up of 1.5%. When did we last see a gap up of 2% or a gap down of 2%?
Right.
Recollect. Is that not the nature of the market? Volatility has dropped because derivative volumes have dropped. And that's good for an investor and bad for a trader.
Got it. So we will leave the beta for the derivatives traders like you and hope that the investors out there do find their alpha. But thank you so much, Feroze Azeez. Pleasure having you as always here on News9.